Hi, everyone. Thanks for joining my webinar today. My name is Denis Kalyshkin. I am the co-founder of Ask VC. I'm also a principal at New York Venture Capital to be a Global Ventures. And I've been on the market. I've been in VC for the last 12 years. I have an aerospace engineering background, so I can understand pretty sophisticated stuff. And I regularly do such webinars to show you how investors are making their decisions when making some deals. And today I'd like to look together with you at the investment case of LinkedIn. Why we picked LinkedIn? There are several reasons. First of all, I really believe that now is the time to kill this monopoly and the new generation of solutions to emerge, because I truly believe that it's a pretty weak monopoly which could be broken. But before you do that, it's always great to look into their previous experience. And why I believe that someone need to break it now is because they're lagging behind into serving the needs of their clients. So they've made many moves that seems weird for me, and at least in the business and in VC world, when I talk to people, everyone says, "Wow, I don't like LinkedIn, but is there anything else?" So it's not that people don't want to switch to something. It's just they can't switch to something, and this is exactly this is exactly why social networks are so good at building monopolies, because they have those network effects, and it's not easy to switch between various social networks. The second reason I've taken this specific case is because this case is public. So Bessemer has made a big present for the whole VC market a few years ago when they published on their website the investment memorandums of their startups which they invested in. Of course, they published successful cases, but at least we have a lot of information which they took into consideration when they were making investment decisions. And you can go to Bessemer Venture Partners website and to read this memorandum. After our call today, I'll send you this video. I'll send you the memorandum. You will watch. You will read it yourself. You will after I walk you through it. You will have an opportunity to better understand how this decision was made. So, because when we take a public case, like successful or unsuccessful case, but if you don't have an investment memorandum, you need to spend like 20, 30 hours to prepare the necessary information, and it will be incomplete, so that you could show how this investment decision was made. So this is why we look at the positive result, and we know that it's a positive result. But at least we have a lot of information, not which you can't easily find in publicly, about why the specific investor made the specific decisions with all the risks which they took into consideration. Okay. And also, what I want to do to say, like a couple of words, a couple of minutes of advertising. So, if you are running a startup or planning to raise funding, so first of all, we are running a Y Combinator application preparation sprint. So, if you plan to apply for it, feel free to join. The first, I will be helping you to prepare your application, and we start next Wednesday on July the 8th. Next, we will be doing. So if you need more. If you need my advice, I do pay the advisory services, so you could reach out to me. And if you're planning to raise funding or want to get feedback on your idea, just shoot me an email or reach out to me in WhatsApp, and we will discuss how I can help you. Okay. And if you're on the other side, whether you're working in venture capital, or planning to build your own investment fund, venture capital fund, or build an accelerator, venture studio, or others, and for some reason you want to acquire the expertise on how to assess startups, and if you need my guidance, please feel free to reach out to me. I'd be happy to help you with this as well. Okay, so let us start. And yeah, the last but not the least, this video will be recorded and will be published on my YouTube channel, Ask VC. So if you don't want that I published like your asking me questions, you just drop the message, the questions in the chat. I will read them and I will share. I will answer to them. Okay. So this is how we solve this IP rights IP rights quest. Okay. So let's start. I will share I don't have a presentation to be honest. I didn't have enough time to prepare it, but I will walk you through the. I will walk you through the investment memorandum. So okay, so what we are looking at? We are looking at a Series C Series C investment of Bessemer, which was which was pitched at the investment committee of December 11th, 2006. And the presenting partner was Jeremy Levine. And it's always great not only to look at the startups, but also to look at the people who actually made the deal. So this is why I looked at the LinkedIn profile of Jeremy Levine. He's the guy. You can read his CV later. So he has been, as of December 2006, he has been a partner at Bessemer for 5 or more years. So he was not new. He has closed quite a few deals. So he had respect in the team. And prior to that, he has always been in venture capital. So he is ex-McKinsey, but he was like pretty young analyst there. Then he worked an associate. As far as I understand, it was also some sort of fund. But what I'm saying, he was a very experienced partner when he was doing the deal, and you can see that he had like some. So yeah, he was board member at Olix, so he was making this deal. Okay, the next thing we'll need to look into is essentially essentially the team. So yeah, okay, like short context. They were doing a deal when the company had already 8 million white collar professionals, so 8 million users, and they were growing aggressively. Before this round, they have already raised 10 million in invested capital. They had 1.5 million in monthly revenue. And now Bessemer was doing a Series C, putting $2.5 million, purchasing 5% of the company. We will discuss it later at 437 pre-money valuation. So it's not an early stage deal. It's more like a late stage deal. And also if you look into LinkedIn history of funding, we can go into Crunchbase. So before this round, the company was backed by Sequoia and Greylock. So it was backed in 2003. right after launching a company at the end of 2020 and 2004. It was backed by Sequoia. Then a year later, they raised 10 million from Greylock, and the next investment round was coming from Bessemer. And another interesting thing, while the deal is not cheap, actually, we will talk about it later. But there were some specific. For first of all, you see, like at this graph, how fast the usage was growing, and the second thing is. They were profitable and they were actually earning like about 11 million, close to 10, $12 million annually. So it was like it was more like a growth stage deal rather than purely like new deal. So let's do the following. You can drop your message. You can drop your questions in the session, in the question session, and I will be answering them like a little bit later. Okay. And before we delve deeper into what they're doing and their story, let's look at their management. So the CEO and founder is Reid Hoffman. And before doing this, before building LinkedIn, he was a pretty, he was a pretty well-connected person. First of all, he is from PayPal Mafia. But back then, like in 2006, PayPal Mafia was not that strong as it is now. But anyway, if we look at his profile on LinkedIn, he he started his career at Apple Computers, but he was like more like a junior person there. Then he worked like a year in Fujitsu, yeah, director of product management, so that's okay, but probably also not mind-blowing. But the main, then he tried to do some startup. Probably it was a social net. Yeah, I read about this startup. This startup was a social network, but it was not a professional social network, but more like a casual social network. And he even raised funding, like about $2 million, and he failed this idea. And then he worked at PayPal. So he joined as a member of board of directors and became executive vice president. So and he was leaving PayPal like either right before or after IPO. So he was a well-connected person, at least with the team of the PayPal, and he was an executive person. And he was and the PayPal back then was a successful company. So it was. It means that he was it was a good signal for investors. I don't know if he personally knew people from Sequoia and Greylock, which closed this deal, but when I looked at Wikipedia, what I learned, one of the first check was written by Peter Thiel, the co-founder of PayPal, and I believe that because of his previous experience of in the social network place, and because of his experience of working in PayPal, and because of the first check of Peter Thiel, it helped him later to secure money from Sequoia, from Greylock, and from Bessemer. So it was not the story of a young guy from the college like Mark Zuckerberg, who built the social network. And also, I want to understand that his company was in the environment when social networks were growing like crazy. We will talk about the competition in a minute, but it was not. He was not like it was not like a very empty space. It was, yes, it was picking up, but big players like Facebook had bigger audience back then, and they could potentially acquire the profession. It didn't happen, and there are reasons for that. But they could potentially acquire the market of LinkedIn, and it was a very material risk which could happen. Okay, so let's look into what we have here in the at the investment memorandum when we talk about the founding team and the management team. So the partner believes that Bessemer, Reid Hoffman had pretty good background, but he's more like a visionary person rather than execution, like a good at execution as a CEO. And he was even saying that, but the guy was a graduate from Stanford, from Oxford, pretty good names. But Bessemer believed that they will need to hire a professional CEO probably. Then they have chief of staff, Sarah Imbach, and she was customer service and fraud at PayPal. So they were also, and if you look into the other team, most of them were at PayPal. So they have previous background working for a successful company, and in previous previous companies, those people like Sarah Imbach, she had a pretty good track records in customer service and support. And here in LinkedIn, and they definitely talked to Sarah when they were making a decision, and there is that there is a comment that she's not so yeah, here she's a very good general manager. Exactly the same comment here about VP of Business Development. He played similar role in PayPal, so he has a pretty experienced business development. Although he is not the co-founder, but this startup is at this stage when not only the co-founders but also senior like managers also pay we pay enough attention to that. And VP of co-founder of VP of engineering. Yeah, like you could read his background here as well, but partners definitely paid more attention to the first three, which I've mentioned. And yes, they also talk about the board of directors. Sequoia and Greyhawk have board seats, so they vote for the decisions, while Bessemer will get only observer rights. So it means that they won't vote. And this means actually, since they don't get a board seat, it means that Reid Hoffman was in a good negotiation position. And this is why I'll tell you in a bit why I also believe so. So this deal was more important for Bessemer than for LinkedIn. So probably like they will Bessemer was luring LinkedIn team to take their money, and the fact that they don't get board seat but instead they have only observer right. Observer right is just a person which sits on the board of directors but can't vote. They can only just listen to what's happening on the board. So that's so they like while they are doing the Series C rounds and putting the latest money, they don't have any control, only other than like general shareholders rights. So so getting back to let me walk you through the other parts of the investment memorandum. So we are investing in a deal in a company which is a pretty fast. It's a pretty fast growing company, and the core product is a social business social network, and it was back then already a social network. And here you can see that how fast the number of users was growing. So they reached like first million in like for 477 days, while the last million of users they acquired only in 77 days. So, you see how it's speeding up, and it should be. Back then, it was a social networks were phenomenon, like emerging phenomenon. So those are pretty good results. And now they are talking about Facebook and MySpace, which were also just were developing. And but instead, like unlike Facebook and MySpace, which were more like casual social networks, they had a social graph, and they potentially could build the professional social networks. But the difference was that when you do when you create LinkedIn profile, you do it for professional reasons. So it's essentially, and they say it that the users treat it as online resume, while Facebook and MySpace were more like about personal life, and people didn't want to mix it up. So this was one of the barriers why while it wasn't that easy for MySpace and Facebook to tap into this field, and this eventually played out that way. But it was not obvious back then. But yeah, so they are. They are talking about this, and describe that for all white collars which were registered on the website, it was essentially a CV. And yeah, they give some statistics that more than 8 million people fast growing and joining. But the biggest problem, and we will talk about this, and it becomes a professional social network. But like at 8 million, it's a good number, but it's not like 800 million, like it's now in 4 or 800 million. So they are still holding a very small percentage of the market. And will they become de facto social network or not? This question is not answered yes yet. And later they will be also we will see it in the risk section. But one of the things which they significantly stressed on is very low usage. So with social networks like Facebook, people were coming there daily, posting and sharing information, while with LinkedIn, people treated it as CV. So they updated it whenever they were looking for a job, and it was not. One of the opportunities for growth was to make users use LinkedIn more often than it is now. So that's back then it was not like that. Okay, so the next section is market and number of paying customers. So here they show the breakdown of the revenue as of 2006, and I remind you that the deal was done in December. So this forecasted numbers for 2006 were very close to very close to actual numbers. So if you look at here are the projections for 2007. So as you see, like they were going to grow it to 2.5 times over a course of year. And as you see, the revenue, they have a breakdown of revenue. So out of 12 million, 2 million were coming from advertising, 2 million were coming from jobs posted on the website, 1.4 million was coming from corporate sales, so it's sales navigators. So very small portion was coming from sending emails, and 5 million, so almost half of the revenue was coming from subscription. And there was a small first client of licensing data. Yeah, we will discuss it in a minute. So and then they looked in the investment memorandum. They looked at each of the business model and made their like reasonable assumptions about how those business model will play out. And what I want to stress here, when you're an early stage startup, like a pre-seed or seed stage startup, you typically have only one or two sources of revenue, like from product. While you're like Series C startup, you have many products. It could be a diversified portfolio. Like with the case of LinkedIn, we have like 6 products, which bring in various we're bringing various revenue streams. So first, they looked into the advertising, and for the advertising, you need to understand like how good is the website from the point of number of digital views, etc. And they and remember it was 2006 and was like early days of the internet. According to statistical service, LinkedIn was the first 150th most popular site on the internet. So pretty good spot, I would say. So it was one of the one of the most visited websites in the internet. And their point here was that probably, especially given that this is the website where people come for professional reasons, white collar people come for professional reasons. So advertising could be potentially a good and growing market. So this then they are talking about some companies which are doing advertising, how much they spend, etc., etc. Then the job site posting. They quickly describe how much the job costs, and this revenue stream is coming from numerous users. Then they also talk about the sales, corporate sales revenue stream, and they just show some big companies which are using this tool and paying for the subscription, and they also show some bigger names, senior managers, which could be reached out via LinkedIn. Then they also say about in-mail messages, but it's a very small revenue stream, not a big. They were not heavily relying on this one. Then they're talking about about 50% of the revenue is coming from subscriptions for premium services, and this is important because their competitors, Xing, they were providing a service where you could not get almost anything without a paid subscription, while LinkedIn was providing many services for free, but they have built a way to earn money on premium subscriptions, and they showed that almost half of the revenue is coming from the paid subscriptions. Also they also show that why it's useful, because you may use advanced filters, and second, third, and the partner used it just to check out how many people he could reach out through third degree network, and he showed that he could reach out to more than 1 million of people. So that he was saying that for networking, for sales, it's a very useful instrument, and this is why people were paying for advanced features. And then there is an explanation how the packages, etc. And last but not the least, it was a very small portion of revenue, but the first hedge fund was attempting to use the data about people, renewing their jobs or quitting their jobs, because it was at the end of 2006, the global financial crisis was unrolling. And this fund was going to use those data as signals that some companies are, experiencing problems. So, and it was just the first contract, but it could potentially be a promising revenue stream. Then they also talk about how they could expand to other products. And one of the risks and challenges which they had as of the date of the deal is that the majority of people using LinkedIn back then were from the tech sector. And that's naturally because they initially spread it across like VCs and people working in the tech sector. And then one of the challenges was to onboard other white collars like doctors and some other types of professionals, because it like, could be a doable task, but so far it was the challenge which they will need to tackle as as a part of this round. Then there is also an interesting blog about the IP, intellectual property. And when I first read it, I I didn't understand why they needed a patent for social networks in the first place. Long story short, Reid Hoffman and his colleague acquired a small company which for $500,000, which hold an IP, initial patent for social networks. And the only reason why they did it was because they want to. They had very well-funded competitors like Facebook back then, and they wanted to minimize the risk. If Facebook would like to close their business, they would they would acquire this small company and say, oh, okay, you infringed my patent. So this is why they acquired this patent. It was not about closing the doors for other social media, but it was more like preventive measure to protect themselves in case bigger players, well-funded players, would like to attack them. So now let's go to direct competitors. So Bessemer says that the biggest real competitor was a German social network, Xing, and as of the date of the deal, Xing had 1.5 million members, and as of September, so like probably as the date of the deal, it was slightly more. But first of all, Xing was a public company. This company was supporting 16 languages, but it was a European company. And there is also an information that they went public. They raised 75 million euro, 35 million euros, and the valuation was to 225 million. So it's Bessemer was closing the deal more or less at the same valuation as Xing was traded publicly. But Xing was like almost all users were paying users. They had a smaller database but bigger returns per user, and they were limited to several European markets. And you also won't find this information in the data room, in the investment memorandum, but I looked through the history. So the strategy of Xing was to acquire their direct competitors, which were building social networks in various parts of the world. And because of that, they supported like 16 languages. But so it was not obvious back then, but later it played out that way. So it was not easy to absorb those acquired companies. So probably it also slowed them down. But the main reason I believe, and so far as I understood, Bessemer believed, was why they were not afraid of Xing, because it was a fully paid social network, and it had smaller database. And here you can find somewhere that only half of LinkedIn users were in the United States, and the number of users in Europe for LinkedIn was more than the total user base of Xing. So kind of they were like more they had a better penetration, but it was not decided yet. Then there are also they also say that there was another social network, Viaduc. It was a French social network. There was a copycat with 650,000 people. So, and this company was like had only 40 employees and raised only 5 million euros. So this company was also behind LinkedIn and Xing. So the direct competitors for professional social networks were the following. Of course, there was a risk, but they don't show it here. There was a big risk from Facebook, and actually, so far as I remember from the history, at some point, Facebook tried to to embrace this business social network feature, but it didn't work out. Yeah, the others were like small users, and as you remember, the company also had job posting and some other products. So for the competition for job posting were like ZoomInfo and a few other companies. But unlike them, LinkedIn provided so they just competed for the portion of the revenue. Okay, then let's look into the financials, and this is also one of the reasons they had a positive decision, because here, yeah, you can see how it grew, like monthly revenue, etc., etc. But there is a table, a pretty good table, showing actual numbers and forecasted numbers from 2005 and for 2006. And if you look at 2005 total revenue, like it grew tenfold. It's pretty ninefold. It's pretty impressive. But what's more important, they compare planned numbers and actual numbers. And if you look at the actual numbers, they are slightly higher than plans for 2006. So they are overperforming, while the results were like, pretty aggressive, like the forecasts were pretty aggressive. They even overperformed those results. And the other good thing is when you look at the cash flow, so they are slightly negative. They have slightly negative cash flow. So they are close to break even. So that's also the other factor which puts LinkedIn in a very, very good position for negotiation. Now let's look at the valuation. So it's a Series C company. They're raising 2.5 million. So the post-money valuation will be to 250 million. They have, as of the date of the deal, they have 12 million in annual revenue. So the multiple to revenue is 20x. So it's like, it's a pretty good multiple. It's not like IPO for SpaceX with 90 EV sales, but it was a pretty high multiple, and and they will get only 5% of the company. So at deals like that, you typically get close to 10% of the company, I believe. So what I'm saying is it was like pretty high valuation, not like immensely high, but Bessemer was overpaying a little bit. But they still believed that the outcome will be great. And actually, if you look at the history, they earned even more than they initially predicted. We'll see it in a minute. But yeah, it was like a pretty, a deal with pretty aggressive valuation. And one of the reasons I believe so is that somewhere in the text you will find information. Here it is. Existing investors refused to participate in the round, and Bessemer was the only investor of the round. So I believe that previous investors, they decided, like the valuation was high, and the previous investors decided not to, not to invest. And given that Bessemer didn't get a board seat, only observers, right? So it means that Reid Hoffman was in a pretty good negotiation position to close this deal. Yeah, and let's look into the risk section. And this risk section is really important for especially for founders, because you very rarely think about risks. You even more rarely discuss the risks with investors. But investors always think about those risks, and we have this section where we discuss like what can go wrong, and we don't tell you what risks we see. We just ask you some questions and then assess those risks ourselves and make our decisions including those risks. So the first risk which they showed, like, yes, of course, is the team. And the good was that talented Silicon Valley entrepreneurs, but the biggest risk they've seen at that point that they will need to hire a CEO, an experienced CEO. They, for some reason, from the conversation with Reid Hoffman, they believe they will need a more senior person who will be ruling the company at the next stage. And hiring a CEO or such a senior person, like, it's always a risk for people, for the team, because you don't know how it works. So, for example, Apple hired John Scully, and we all know the story how it ended up. The second risk is usage of LinkedIn. And they say they say that there are many features which will make people to use LinkedIn more often, but so far it's not the case. So this is the challenge they will need to tackle. Like, social network needs someone to use it more frequently. And the third risk they've talked was like the industry expansion. So yeah, they have like about 80% of Google workers using LinkedIn, and many people from Fortune companies in tech sector using LinkedIn, but still expanding penetration in other industries was a challenge. It was not like challenge which you couldn't solve, but it was still the risk for the round. And the last but not the least is the scenario analysis. So Bessemer always, when they make a decision, they look at various scenarios of the exit opportunity, potential exit opportunity, and the number and the money they could earn. So if you look at the numbers, so you see that the chance of writing off a company like is 0.5%. So like they just didn't do it exactly zero, because anything could happen. But the chances of this company going bankrupt was they expected to be very low. Then the other exit value of 30 million was also like they expected it to have only 5% chance of happening. And even in this case, they will be returning. So they had probably preferred liquidation preferences. They will be returning, returning some money. And they expected that they will return like 0.6 million. So it's also like losing everything. So you see here the amount of so at the table at the column value, you see how much money the company the Bessemer will earn. In the case of exit for 75 million, they will earn $1 million. And in the case of selling and they expected this chance to be 10%. So while they were, investing in 250 million first money, so they expected the base case scenario actually was like either selling a company, a little bit low, this valuation for 150 million, or a little above of this about this valuation for 300 million. And the chances for these two scenarios were about 50%. Then they looked at the positive scenarios, like 15% was that they will double the valuation. 13.5% that they will triple the valuation. And they had only 5% chance that the company will cost over a billion and 200 million, and only 1% chance that the company would cost like 2 billion 100 million. And the weighted ARR, so they expected the exit value will be like in 2 to 3 years, and the ARR will be expected ARR will be 23%. So yeah, so that's the deal. That's how they made this decision. Feel free to ask your questions, please. Do you have any questions? Okay, Alex is right in the question. Yeah, if anyone else have question. Dmitry asks says that it will be great to hear about the disruption of LinkedIn. This is the next webinar which I will be doing. We will be brainstorming together how to tackle this. But my point is, first of all, LinkedIn started to block people more often, and as they said in the CV in their investment memorandum, LinkedIn profile is essentially a CV. And now I've got blocked several times, and many people invest a lot of money to create an asset like your CV, your profile on LinkedIn is not only a CV now. It's an asset. Like, some people invest millions of dollars in it. And if you're blocked, if your company removed from LinkedIn, or if you are as a person removed from LinkedIn, like, you are a weirdo. For example, when I was blocked, and I was blocked for 2 weeks. People were reaching out to me and saying, "Hey, I can't find you on LinkedIn. Like, are you a real investor or fraud?" So it's not the thing which professionals and especially companies would like, the risk would like to bear. And I'm pretty sure that some solution which will give you back ownership, at least like in the limited format, but still give you back ownership of this digital asset which you invested in, like this is what will be happening in the future. Okay. So Nadezhda is asking like how they started to acquire first users. I don't know for sure. So far as I remember, they initially started as a social network connecting investors and startup founders. But anyway, it was the bubble of IT sector, startups, investors. So this bubble, because they were like and it was like the handshakes. But the more I can't tell you the broader story, because I didn't delve into it. But you can Google, and you can read the story. Okay, the next question: how the probabilities of exits were calculated? Okay, so it's a combination of wild guess and some historical statistics. So why I went this time, I walked you through the statistics. So they looked at so they had to show 6 scenarios. So probably they have some framework inside Bessemer saying like, okay, you need to draw 6 scenarios. And so from what I've seen from other investment memorandums, they oftentimes show like those ranges from like 0, 30 million exit all the way to 1 or 2 billion exit. And then they, assign some weights to those. So they have some statistics probably with their portfolio where they see, okay, what are the chances they, landed on this, on that valuation, and also depending like depending, what stage the company is, you reasonably estimate that, yeah, probably like fully writing down the company is not the case. So they put 0.5%. They couldn't put zero, so they put very small chance. The others, like selling the company for 30 million, was also not a big chance. So they, like, it was a so-called expert opinion. Okay, let it be 5%. But the majority scenario, they believed is that I probably believe they understood that they overpaid a little bit for the company. So they were saying like, okay, we either sell it a little bit, lower than our entry price, or a little bit higher, but we wouldn't earn much. And as it always the case, there are some small chance of like doubling and tripling and making 10x on your investment. Okay, so Alex, when Bessemer looked at LinkedIn in 2006, what do you think the actual internal assessment flow looked like? Was it partner-led from the beginning, or would an associate or principal first build a market traction and competition? I'm almost 100% sure that this was a partner-driven deal. So first of all, they were doing a Series C deal. And yeah, I'm pretty sure pretty many partners in venture capital, use LinkedIn at that point. Like Brett Horfman was pretty well connected, and they raised from Sequoia and Greylock. So this company was on the radar on the partners, not associates. And it was pretty sure that it was like that. Okay, they got introduced, or the partner used this solution and badly wanted to invest in some social network and know LinkedIn things and others. And I'm pretty sure it was a warm introduction, not cold reach out. Okay, can you provide one or two risks to evaluate? Where you do your analysis? You mentioned earlier that you ask the startup. So okay. I probably need to do this lecture once again, but there are dozens of risks, and like there are political risks. For example, like you probably all heard that Anthropic was blocked. Their latest their latest model was blocked by government. Yes, it was released again, but first it was blocked. And for most of the founders, it came as a surprise, to be honest. But for me, it was like very obvious risk as an investor. Why? Because there is a government like framework. There is CFIUS in the United States, which tracks this critical investments in critical technologies, or regulates critical technology. So AI was in the list of critical technologies like at least for 5 years. So some of these AI companies, they have generals like like people from military on their boards. So it was the matter of time when this risk should be materialized. There is another risk no one is talking about. For example, yes, now we have a shortage of data centers, and but there is a political risk. For example, China could block Taiwan for 2 weeks, and it could kill like the whole hype of AI, just because like with this risk of the technology being blocked by government. It was very material risk, like investors should be account for this risk. It was like very reasonable. Then you have your assessment. Okay, is it like how likely is that this risk will materialize? So I would say that the risk of at some point, introduction of regulation or blocking or something happening along the way with Anthropic was a very material risk. It wouldn't be like 100% risk which will kill the company, but it will be like we would be discussing, okay, if there will be like a regulation will be introduced, and if it restricts usage of this technology only for US and some export control measures, how it will affect your revenue. And we will be assessing, for example, okay, we will limit the revenue of Anthropic for only with with the United States and the companies which it could be plan B, or you will need to do something else. But there are dozens of risks, and you can go to ChatGPT or some other LLMs that you're using. You can prompt it and say, hey, what types of the risks are there, like economical, political, business, etc. And like you get this extensive list of potential risks, and then you go through it and say, okay, this risk is real. Back then, like 20 years ago, like political risk, no one took those political risks into consideration. So when LinkedIn was expanding globally, this was like, yeah, theoretically this risk was could materialize, but in the world, when this deal was done, it was it was not such a huge risk. So you, out of dozens of risks, you just pick the ones which you believe are more or less critical. So you show 3 to 5, and then you ponder upon like how it affects your company and what you will do in this case. If when you're making decision, if you see a very material risk which could kill your company, then you avoid the deal. Or if you have a risk which will, if in case of materializing, you will, which will significantly change your like the revenue stream of your company, invested company, then you can add some terms in the agreement, in investment agreement, where you say, okay, if this risk materializes, our share will increase, something like that. Okay. Anyone has any other questions? Yeah, I see Vadim has a question. Thanks for the presentation. Now we see the internal document. How did they get data? What data comes from company? What market from market analysis? How can we compare the data from the bubble with the current data? So this is a good question. So typically, you as an analyst, you get several sources of data. You have public data. You have the data which the company provides to you, and like if you want to understand the product, so you go to test the product of the company, then you come to founders and say, okay, what's your vision on that one? Sometimes you talk to experts and to clients to better understand like the usage, etc. But in case of LinkedIn, they didn't talk to clients. Probably there were several reasons for that. First, like it was a pretty hot deal, and again, as I said, like Reid Hoffman had strong negotiating power, so they didn't have much time to close this deal with all this negotiation and do a thorough due diligence talking to experts. And on the other hand, it was the type of the product where you could go and test it yourself. So if you were doing like a more sophisticated things like some enterprise grade solution or something like very specific, then you would probably talk to experts. But in case of this company, it was not the case. Then you, as like with the financials, you definitely rely on the data which the company provides you. Oftentimes you hire, if you have time. Not sure that Bessemer had time to do thorough financial and legal due diligence for this deal because it was pretty hot. I'm pretty sure. But if you have more time, then you hire legal and tax advisors and financial advisors who double check the financial data as a part of the due diligence. Yes, you can find public data, and especially when it comes to the market. So you market and competition. Of course, part of this information is coming from the competitor, from the company, and then you also go and try to challenge those assumptions, looking at public numbers, talking to experts, using like doing your research. And then when you get some public information, of course, the team has more, the team of the startup has done a more thorough research, so they are knowing better the competition and the market size, and you can show them your findings and challenge their assumptions, and they will answer to you. So this is how this information coming. And if you compare it, the available data in 2006 versus what we have now, when we assess a startup, we have far more information than 20 years ago. So like you can imagine, so now, for example, when I do assessment of a startup, I go to LinkedIn and see how headcount changed, like to better assess the size of the company. While back then it was not available, and many other resources and statistics and historical data about previous companies which raised funding. So now we go when we need to look into some company, the background, what was happening with the company. We are going to Crunchbase and looking at some their competitors, what's happened with them. Back then it was not this information was not available. So now we are far more advanced into the tools and the data which we could scrap from the internet to put together a digital footprint and better assess the company than it was 20 years ago. Okay, one more question. In your view, what have been the decisive factor for LinkedIn? User growth, network effects, monetization ready working, red hormones, and a team. All that you've named. So look, it was a Series C deal. So at this Series C, you have like a few competitors which are close to win the market, and they were even showing that they were expecting to exit from this company in 2 to 3 years. So they were not betting on a very new company. They were betting on one of the champions. So and they're like so I believe that's like the line of thinking. I don't know that for sure, but I believe that the line of thinking was that back then. Okay, social networks are growing. For example, we missed some social network or invested in some social network. It's a great business model. We see network effects, etc., etc. And they knew like what types of social network startups at what stages are on the market. Okay, there is LinkedIn, there is Sync, and there are some other smaller companies. And they looked at all of them and they said, and they were introduced to Reid Hoffman probably. So cool team, not the first time they're doing it, backed by good VCs, growing as crazy, having a bigger user base than theirs, like best competitor. The competitor is a public company. So it's just all the factors together were drawing a pretty compelling story. Yeah, another question. Do you know people who invested in a company seeing significant risk, convince you to proceed and would consider So I would like a dual use Spice Tech Bio. Um, so I personally can't invest in it from my fund, but you can reach out to me via Denis Space Ambition. Denis. Yeah, you can reach out to me via link via email, and I can talk to like I can talk about your case. But getting back to your question, do you know people who invested in companies where when the company had significant risk? We always do this. Like this is what VC market is all about. If you don't take significant risk, especially when you invested pre-seed and seed, there are so many risks there. So if you don't take enough risk, you just won't get enough returns. So in case of LinkedIn, one of the material risk was like, okay, we're participating in a slightly overpriced deal. So probably the base case scenario is that it wouldn't grow that fast, that high, and we just like, okay, we will return the money we invested. So that was like I believe that was one of the biggest risks there, and of course, the market risk was presented there as well. But yeah, it's yeah, there are, and actually, if you want, you can read the case investment case of Twitch. It has like far more risks, like because the one co-founder was leading, CTO becoming CEO, and other stuff. So if you want to see a deal with bigger risks, so Bessemer invested in Twitch. That deal had more risks, and they invested like $18 million in that company. Okay, so Alex is asking, Dennis, you don't really like LinkedIn. If someone were building a LinkedIn serious competitor today, what would you as a VC need to say in their offer to DEC to genuinely interested? If anyone is really going to build LinkedIn competitor, you write me an email and we will discuss it. I talked with my general partner about this idea, and it didn't sound like a crazy idea. So we just need a strong team which is building a competitor, and I'm pretty sure I can persuade my manager to put the first check in the team if the team is good. Okay, so that's the answer. So this is why I'm saying it. I really believe we can build $1 billion company and we can grasp a share of what LinkedIn has now, because LinkedIn is it's a company which is it's a sister company of Microsoft. Yes, they have $16 billion in revenue, but it's split among various products, and not in all products they are strong. For example, when it comes to sales and social media, they are not a strong competitor, and they are managed by a huge conglomerate. You can kill this business, and there are many features. For example, there are many decentralized social networks which arise, and LinkedIn is a professional network. It means that people can pay for services. They can afford to pay something to at least the premium users, which would be Halden premium accounts. Okay, of course, if you're a developer, you like use it as a CV, you don't need this. But we're talking here about founders, about C-level managers, about influencers, or professionals who are making money using LinkedIn as a main source of leads. These people will be open to pay just to have the chance to keep just to keep their business professional media, to keep ownership of it. Okay, so far as I see, there are no other questions. Yeah, so I hope that you find our conversation today interesting. Yeah, I plan to do more things, more webinars like that. I will probably in a couple of weeks I will pick another company to consider. And stay tuned. And yeah, subscribe to my LinkedIn. Subscribe. And again, if you need my help, like either you're a startup founder or building, like, or becoming an investor, business angel, accelerator, venture studio, etc., and you need my help, you reach out to me. Let's have a conversation. Yeah, deep tech and hardware. Yeah, like first of all, I already made a deep tech deep dive into the investment case of Rocket Lab. Unfortunately, Bessemer doesn't have many deep tech investment memorandums. I have several investment memorandums of space tech companies, but that is boldly written that I can't use them publicly. So if you come up, or if any one of you will come up with a deep tech, any deep tech in public investment memorandum you would like me to consider, you send me. I will read it through and I will show how this decision was made. Like I really want to do more, those, more show more deep tech cases. Okay, Paul, thanks for your idea. Alex, I'm happy that you like it. Okay, guys, and thanks for joining today. I will be sending tomorrow the video recording, and I will be sending my contact. So let's continue our conversation, and I will be always happy to help. And yeah, if you liked it, like please share the video recording, like spread the word so more people could watch it, could get the knowledge. Yeah, so much appreciated. Have a great day. Bye bye.